why is the Fed pumping monies into our economy if our economy is on a a roar?
Yeah. Boy, that's a really good question, Greg. And so here's the thought process. I don't necessarily agree with this 100%, but I agree with some of it. So the theory is, some of the theory of the economy being so strong is because the Fed has continually, pumped money into the economy, giving the financial sector more liquidity, more opportunity to buy, borrow, lend. And that liquidity helps the economy. So when the economy is thriving, there is more demand for borrowing. Companies are expanding, they're growing. Money is so cheap that they don't want to use their money in their savings. They would rather borrow the money. What happens is there is a lack of liquidity. Banks go to the Federal Reserve and they say, hey, look, I need at least $100 million. Can you give me $100 million? And here is my balance sheet that verifies that I meet the requirements equity-wise to get this $100 million. Now, they don't really have to get approved for the $100 million. They just have to prove that they have the liquidity to back it up. Once they do that, they go to the Federal Reserve. The Federal Reserve gives them the money. They charge them 1.6% interest. That's the Fed rate that we're always talking about. They charge them the rate for that money. They take that money, and now they can lend that money out into the marketplace. And maybe some of it's consumer, maybe some of it's mortgage companies, maybe some of it is hedge fund people, maybe some of it is commercial lending because companies are expanding, growing, and all those kinds of things. So when that gets low, when the liquidity gets low, the Federal Reserve needs to supplement it. They don't have to supplement it, but if they don't supplement it, what's going to happen is the interest rate, the overnight lending rate, they call it, is going to get very, very, very high. All of a sudden, it's going to go up into double digits, 9%, 8%, and then it's going to end up in 10, 11, 12%. That's going to start to put burden on the banking system, and they'll stop borrowing. And when that happens, it shuts down the economy, literally. It can shut down the economy. So in the case of one night or one day or 1 week or 1 month even, it's not going to be a dramatic shutdown, but it's going to put the brakes on hard. So the Fed is trying to weigh this balance of that lending and those repo rates and the money they put into liquidity. They're trying to keep that balance so that the economy that is thriving anyway has the resources, the money, to continue to thrive and grow and build. And that's what's happening. That's one of the reasons why the Fed is continuing with quantitative easing, I'll call it, or pumping money into the economy. It should act as, and it has acted on Wall Street, as a confidence booster. So it's said to Wall Street, you know what? The Fed really believes that this growth that is happening in the economy is very, very real. And that gives them a sense of confidence as well to continue to buy stocks or, stay in the markets and so on and so forth. And I think right now it's still somewhat valid. I would rather them at the same time increase rates, not lower rates, and just tick up the overall interest rate a little bit more, because that makes sure that the dollar is staying strong. But we have kind of a weird thing going on right now where the dollar is still maintaining an enormous amount of strength. It's the best currency in the world. Hey, remember, to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.TV. That's FISM.TV.